Hey everyone, so let's talk about March. If you felt like the market gave you some serious whiplash, trust me, you are not alone. It was a stomach-churning drop followed by this shocking last-minute surge. So today, we're going to break down that whole roller coaster ride, and we're going to look at what the historical patterns tell us about April. Is there more turbulence ahead, or are we setting up for a big spring rally? Let's dive in and figure it out. I mean, let's be real for a second, right? That was an absolutely wild month. One minute, you're almost afraid to even look at your portfolio. And the next thing you know, it's just a sea of green. Getting a handle on this emotional roller coaster is, honestly, the key to figuring out what might be coming next. All right, so let's get past the feeling of it all and look at the cold, hard facts. Let's actually quantify the damage. Just how bad was the whiplash in March? Let's look at the numbers. Okay, so what's really fascinating here is that these numbers, you see a 5.1% drop for the S&P 500, over 4% for the Nasdaq, they don't actually tell the whole story. Not even close. I mean, as painful as they look right now, you have to remember these are the final numbers after a massive rally at the end of the month. For most of March, believe me, the picture was much, much uglier. So how much uglier are we talking? Well, at its absolute low point, right around March 27th, the S&P 500 was actually down over 7%. That was the moment of maximum pain. When all the news was swirling, volatility was spiking, and it felt like every investor was just heading for the exits. It really had all the makings of a classic, painful pullback. But then, just when it looked like the month was a complete and total loss, everything changed. Seriously, what happened in just the final days of March completely flipped the script. So get this. On the very last day of the month, the market just came roaring back, and it was led by who you'd expect, the big tech and AI names. Just look at these single-day gains. Meta jumping almost 7%. You've got Nvidia and Broadcom right on its heels, both up over 5%. This wasn't just some little recovery, folks. This was an aggressive, full-on stampede of dip buyers. And this surge was just so powerful. You can really see it here just how much a leader like Meta absolutely blew away the rest of the market. That single-day explosion in the Nasdaq, that's what saved the monthly charts from looking a whole lot worse, and it set a completely different tone as we headed into April. So that brings us to right now. After surviving everything March threw at us, is there actually a reason to be optimistic? Well, if you're someone who believes in historical trends, the answer is a pretty resounding yes. So let's dig into April's track record. Check this out. Going all the way back to 1950, the S&P 500 has posted an average gain of about 1.6% during the month of April. That's huge. It consistently ranks as one of the strongest months of the entire year. It often even rivals the famous Santa Claus rally we see in December. Pretty incredible, right? And it's not just about the size of the return. It's about the consistency. Think about this. Over the last 20 years, April has finished in the green somewhere between 70 and 80% of the time. I mean, that is an incredibly high win rate. It really suggests there's a strong seasonal tailwind pushing things forward. So what's actually behind this so-called April effect? Well, it's not magic. It's really a combination of a few key factors. First up, you've got tax refunds hitting people's bank accounts, and some of that cash finds its way into the market. Second, there's always that buzz and anticipation around the upcoming Q1 earnings reports. And finally, it's a new quarter. That means a lot of fund managers are putting fresh capital to work, reallocating their portfolios. Okay, but before we get too excited and just start penciling in guaranteed gains, we have to remember something really important. History is a guide, not a guarantee. So it's time for a quick reality check. So while that historical case is super strong, we absolutely cannot ignore what's happening right now. For example, just look back 2 years ago to 2024. April actually broke its winning streak and finished down about 4%. So exceptions are always possible. And this is maybe the more important point for us right now, you have to ask, did that monster rally on March 31st basically steal some of April's thunder? It is a very real possibility that some of that new quarter money got put to work a day early, to catch that bounce. And if that's the case, it might have front-run the typical April rally. And all of this, the data, the crazy volatility, the historical trends, it all brings us to what might just be the most important factor of all, our mindset as investors. I mean, how do you possibly stay disciplined when the market is trying to give you whiplash? The legendary investor Peter Lynch gives us the perfect place to start. His advice, it speaks directly to that moment in March when we were down 7%. Your gut feeling was probably just screaming at you to sell, sell, sell. But Lynch reminds us the real trick is to tune out all that noise and just ask one simple question. Has the fundamental story of the company I invested in actually changed? And for most great companies, the answer back in March was a clear no.
And Charlie Munger's wisdom, well, it echoes that exact same idea. In a month like March, the temptation is just overwhelming to constantly react, right? To sell the dip and then immediately try to chase the rally back up. But Munger argues that the big money, the true wealth, is built by having a plan and just sticking to it. It's made in the waiting through the volatility instead of trying to perfectly time it. So what about when the market finally does turn, like we saw at the end of March? Well, this is where Warren Buffett's advice is just so perfect. He says, when it rains gold, put out the bucket, not the thimble. And that recovery after a sharp downturn, that is the rain of gold. For all the investors who weathered the storm, this is the time to embrace that upside with a bucket, not to shy away with a tiny thimble just because you're still spooked from the pullback.
And finally, Sir John Templeton gives us what is, I think, the ultimate psychological roadmap for the market. Just think about where we were in the middle of March. That was peak pessimism, right? Everyone was scared. Well, according to Templeton's framework, that's the exact environment where new legs of a bull market are born. So what does that suggest? It suggests that even with this recent recovery, we're likely still just in this skepticism or maybe the early optimism phase. A long, long way from the dangerous euphoria that usually signals a market top. And so that leaves us with one final and really critical question to ask yourself. As you look at this market recovery and you think about the historical strength of April, are you feeling optimistic? You know, that healthy sweet spot for growth? Or are you starting to feel euphoric, that dangerous belief that things can only go up from here no matter what? Your answer to that question might just be the key to successfully navigating whatever comes next. Thanks for tuning in.